Welcome back to another Tech Talk from MarketEdge.com. I hope everyone had a wonderful 4th of July weekend. My name is Rachel. With me today, as usual, is David Blake, our certified market technician, here to review last week's stock market through a technical analysis lens. David, take it away.
Okay, well, last week investors came in a celebratory mood on the holiday shortened week. We saw the S&P 500, the NYSE, the NASDAQ 100, and even the Philadelphia Semiconductor Index all set new all-time highs. So it was a strong week. Major averages were up 2%, 1.5%. I think the small cap Russell 2000 was up 3.5%. So it was one of the big leaders. The semiconductors were up for something like how many weeks in a row? Probably, something like 10 weeks in a row, it's been moving higher. We started to see, because the run yet last week, we saw that Jerome Powell, he was a little bit dovish on yields. He came out and said that, he thought the yields would probably be lower without the uncertainty of the tariffs going forward. He still doesn't want to move and then have to change directions on that. And that kind of boosted the market, and yields actually came down at that point. But then, we had that better than expected jobs report from the government, which gave a little boost to equities, but it did see yields tick higher on that. And it probably took July off the table for the next FOMC meeting to cut rates. But in fact, I think we were around 85% for September rate cut about a week and a half ago. And that's now down to 71% probability. That's how strong the jobs report was. We keep waiting for these tariffs and layoffs to start slowing the economy down, but then you get a jobs report like that. And the Fed's just kind of sitting on its hands right now. Again, we may get a little bit more of an answer on that if the market starts to pull back this week. Finally, the rally was across the board. Every sector was higher. It was led by materials, consumer discretionary, industrial, and financial. I think the industrials and financials both hit new highs. I'm not sure what other ETFs or sectors are hitting new highs. I'll have to check. I have a note on that on this Friday's letter. But anyway, at the end of the week, it looked like the Dow Jones was getting ready to join the other major averages at a new high. But, that and this S&P 500 were on a 2-week win streak. The Dow and NASDAQ were on a 3-week win streak. The technical condition going into the weekend was still strong, but it was overbought by several measures. You had the 14-day RSI rising above 70. That's considered overbought, not extremely overbought. You also then had the Market Edge S&P short range oscillator, which you hear Jim Cramer talk about a lot. That closed the period at 8.25%, and that's very overbought. I don't think it's been that overbought since maybe January, February. That just shows that this rally is extended. I wrote that, historically, that's led to some profit taking by the pros that keep track of that oscillator. That's kind of what we were getting yesterday. We're getting some pretty choppy trading in the market. The Dow was down about 400 points, so we want to watch that. Another strong thing we had last week, we still have the ADXR line confirming the strong bull trend. It was rising. We had the volatility index come down around 16, which that implies that traders aren't real worried about a big pullback at this stage. We were up close to 25 a couple of weeks ago, and we've come all the way down to the 16. We also saw the Russell 2000 and the transportation index and the semiconductor index again outperform the broader market. Technicians like to see that these secondary indexes kind of lead the market higher and lower. That's a way you can gauge the strength of the trend. In fact, our momentum index that you'll see in the market letter takes that into consideration. If the other indexes are outperforming the Dow, that's a bullish sign for the broader market. So things look good there. Underlying breadth in the market continues to confirm the trend that we saw. The NYSE advanced decline line, which we consider a leading indicator. It's one of the few leading indicators for the market that you're going to find. And that's making all-time highs. We made a new high, I think, something like for 4 out of 5 days or 5 out of 6 days over the last week or two. And then we also saw the NASDAQ AD line, which isn't as important because it has a lot of different junk stocks in it, but it's also at its highest level since February. So that's a positive. That also means that you're seeing an expansion in the advancing stocks versus declining stocks, which means you have more leadership and broader leadership. We're getting back to the point where we saw a lot of the Mag 7 start to trend higher and outperform. I think the fact that now with the AD line making new highs again, that's a healthy sign for the market that we can continue to maybe push a little bit higher. They also had the new 52-week highs outdo the new lows on both the NYSE and NASDAQ. And that was for an 8th consecutive week. And we are seeing expansion in those new highs, which is also a good sign for the market. Now, one other red flag besides being overbought is the fact that we are starting to see a little bit more of a jump in the bulls. We saw the retail bulls finally get above historical averages. They had been below the historical average for them of 37.5% bullish, something like 19 or 20 weeks in a row. And now we saw them jump last week from 35% to 45%. That's a pretty big jump, 10% in a week. It's not at a frothy level yet. I think that is the highest percentage of bulls for retail clients since December. But if we get much higher, we get up above 50. That's getting a little frothy for retail. And then we saw the percentage of bullish investment advisors jump from 38.8% all the way up to 51%. And that's their highest level since early January. So we are getting both retail and the pros kind of getting back on board of this market. We talk about that. You hear people talk about FOMO, the fear of missing out, and people start to rush in there and start buying stocks because they can see they're on the wrong side of the trade and they want to play a little catch up. I think that's what we're seeing in here. As far as the week going forward, we have the Small Business Optimism Index. That'll be something we'll look at just to make sure the smaller businessman feels good about the economy. When you see that moving up healthily, that usually is a sign that you'll see the Russell 2000 Small Cap Index nudge a little bit higher. And then on Wednesday, we have the tariff pause ends. And yesterday morning, we had the Secretary Treasurer Bessent talk about extending a lot of these tariff deadlines out a little bit further. So they're going to be kind of, weighing these things back and forth. I'm sure you're going to get some tweets from the president. He likes to, get these headlines going and rile things up. I'm sure you're going to see a lot of things like that, which is probably going to make, increased volatility next couple of days. And then tomorrow afternoon, you also will get the FOMC meeting minutes. That's something to pay attention to. That could move yields a little bit because you just want to make sure to see whether the fact that they didn't raise rates in June, was it unanimous? Was it half the group? Did some of them think they should be moving? You just get a little bit more of a feel to how close the committee is to cutting rates. And right now, a lot of this action that we're seeing in the market is the fact that investors are counting on deregulation in the banks and in business, and also lower rates that can push the market up. Now, one thing that you need to know, the market always looks about 6 months ahead. So they're already counting on rates being lower, at least in September and maybe in December. And so that's something you want to watch. But the FOMC meeting minutes will allow you to see how close the committee is on that. On Thursday, we get another initial jobless claims. A lot of the headlines we keep hearing about, Microsoft's going to lay off 12,000 people and Facebook is going to lay off 10,000 people, but it's not showing up in the jobs reports. That's something that we want to see. When you start to see a crack in that could be a sign that we might see rates drop a little bit lower to keep the stimulus going. That's kind of your highlights for the week going forward. There won't be many earnings reports coming out, but probably in another week and a half, we'll start to look at the second quarter earnings, which will start to roll out with the big banks. So other than that, expect some choppy trading. Again, the fact that the SRO is so overbought probably means that you're going to see some back and forth consolidation in the different indexes this week while these events play out.
Very good. Thank you for that explanation of all of the volatility and frothiness we may be seeing this week based on last week's activity. Is there anything else you'd like to add?
And that's about all we got for today then.
All right, great. We'll chat next week.
Okay. Thank you.
Thank you. Bye.